Hi folks, Mike Lynch here from Barnum Financial Group, where my team helps you build and implement financial plans to help you achieve, live your life's great desires. These are our long form videos where we take you behind the scenes and really show you how our team, me and my team, look at your financial plan and financial plan for our clients. Now today's topic is one of my favorite. Choices, the menu of financial choices. Now, I've been using this tool with clients for over 20 years. And many of you know I've written a book. My fourth book is out. It's called Start Now, Grow Big. And it's all about doing stuff, 20s and 30s, to build boatloads of wealth, financial freedom, financial independence in your 40s, 50s, and 60s. Depending on what it is. And this is a tool. So this goes along with that. Now, speaking of tools, what I want to make clear is that we're going to talk about a lot of different tools today. A hammer is a tool, right? We're talking about resources and tools. So, some of these tools you might have a bad notion of. There's no such thing as a bad financial tool. Hammers, the last time the FBI found it, it was in my book, killed 500 people in a year. 500 people were killed by hammers. Doesn't mean a hammer is bad. It just means it was misused when it killed people, right? When it killed people. There's plenty of right ways to use it. So, the other thing what I want to talk about is some of these tools that we use, they're going to be like a plunger, right? Now, a plunger is something that has a specific use. You know what it is, and you don't really want to use it for anything else. So, for example, you could put a beer in here and drink a beer out of here, but it's probably not a good idea. The handle's a little bit flimsy, probably not a good pry bar. If you're trying to scold somebody with it, probably wouldn't work. So a plunger is an example of a specific tool. Some of these tools we're going to use are going to be more of a multi-purpose tool. We call them a Swiss Army knife, but Swiss Army knives are very expensive, and multi-purpose hunting and fishing tools are less expensive at Walmart. So that's what I have here. It's a set of pliers. It has a pocket knife. It has a file. Maybe you could use it for a fingernail file or file some, it has a screwdriver. It has a lot of different things. It is not going to probably be as good as a specific tool for any specific thing, but there's going to be a lot of uses, and it's going to give us a lot of flexibility when we fold it up. So one notion I want you to think of tools and how we use these tools. We use different tools with different people depending on whether they need very specific uses. They need to unplunge a toilet, or whether they don't know what life's going to bring and they want to have something that they can pull out and use at that time. So that's one thing, the tools. The other thing we're going to talk about here is what resources are we doing? We're always allocating resources. So one resource we use when we build wealth for clients is free cash flow. What comes in, what goes out, what's left to invest for the future you. Second one is accumulated assets. Do we have lazy? We want all your assets working hard. We want no lazy assets. So is there too much money in a checking account not getting interest? Can we reposition assets? And believe it or not, another resource is the tax code. Yeah, you wish it wasn't there, but it is there, and it's a code. And if you can crack it, you can really increase the amount of after-tax money you're going to have at each stage of your life. And there's a bonus one I even put on here, and that's going to be called your good health, right? Your good health. And another one might actually even be a good credit score. So we have a lot of different resources, but the big ones are going to be free cash flow, accumulated assets, and the tax code. What we're going to do then is use these free cash flow, accumulated asset, and tax code to allocate across goals, a cash reserve, right? We know we have to have 3 to 6 months in a cash reserve. Life is coming your way. You might need a down payment for a house, or a house of a kid or a grandkid, a wedding, a car. Those would be intermediate term or short term savings goals. A longer term goal is retirement, financial independence. At some point, you might want to quit working for your money and have your money give your income. We got education, right? Yeah, they say, I don't know, education's expensive. You want to build up money for it. Look, folks, all financial plans work on time and money. Time and money. You need to protect your income. Most people's biggest assets is their ability to make an income. What if you can't make an income? We have to allocate some money for protection. A plan without protection is just a bet, and we don't like to make a bet. Now, taxes are a price we pay for civilization. but we'd really rather pay less. So we want to look at taxes. What are the tax implications? How can we leverage that? And of course, wrapping it up. Wrapping it up means, unfortunately, you might be gone, but where's your money going? What do you need to make sure? So these are going to be the goals that we allocate across. All right, so now let's get going and let's look at how we do this. So the first goal is going to be pretty basic. Cash reserve doesn't require a lot of explanation, but where could we have it? Well, the one place you could have the money is in a bank, right? And that money in the bank could be in a savings account, could be a checking account. You could have money in a money market account. Money market account might be direct with an investment company. It might be in a brokerage account, right? It might be in a brokerage account. You could have short-term government bonds. They come due 3, 4, 5 days. What's the risk? U.S. government, it's very low risk. Good cash is going to be there. And then, of course, you could use the fixed account in a permanent insurance product, a life insurance product, or an annuity. All these could be used for a short-term cash reserve. Now, with the cash reserve, one thing we know is that once you have, how much money should be in your checking account is a question we get. Well, you want enough money in your checking account so you don't bounce a check. That's the first thing. The second thing you want in your checking account is you want enough so you don't have to pay a fee to have that checking account. But once you're not bouncing a check and you're not paying a fee, we want our clients' money working for them. We don't want lazy money. We want you to get interest. So that's why you move down to the money markets, the short-term government bonds, and even the fixed account in the insurance product. I'm going to tell you a story about that a bit later, right? Remember, a tool. Tools can be used very good for very bad, but if you know how to use them, you can get a lot done. The next one we're going to move to is, let's say, intermediate term goals. A goal that's going to be probably inside of 10 years, maybe it's 2 years, maybe it's 5 years. We want to accumulate. I want to accumulate for a house down payment. I want to accumulate for my wedding. I want to accumulate to buy a car. What are some of the things we can use? Well, again, it's pretty obvious. We can use banks. We can use money markets. We can use short-term government bonds. You see, it's very similar. We could use fixed insurance accounts. But now, guess what? We could also use balanced mutual funds or even exchange-traded funds. And let me give you another one you could use that's not even on here. You could use a Roth IRA. That sounds a little bit crazy. Now we're getting into our flex tool. Okay? Now we're getting our flex tool, but I'll tell you a little bit more about that later. Okay? So, the next area that we're going to move to is going to be education. Now, the first, the easy and the obvious, is the Section 529 plan. The Section 529 plan, my friends, is a plunger. Your bank checking account is a plunger. Your Section 529 account is a plunger. Why do I say that? It has a specific use. It's a very tax-favored account to finance qualified higher education expenses. Yes, they've been making it more flexible, but it's primarily a tool designed to pay for higher education, and it's fantastic. Well, but some people say, what if we want to do that? Well, you can have UTMA accounts. Uniform transfer to minor account. This is an account where you're a trustee, but the account is in trust for your child. There's some pros and there's some cons of that, and we'll get to that later. But a big con is, for education, while the 529 is great for education, that the UTMA is not great for education because it counts as a child's asset. Also, when the child becomes an adult at 21, it becomes his or her money, and that's something to think about. You could use for education after-tax investment account. So I want my son to go to college. I could invest money in an account. If he doesn't go, boom, I can use it for something else myself, or I can give it to him. On the other hand, what's the downside? Well, I'm going to pay taxes. There's a Roth IRA again. There's a Roth IRA again. What happened with the Roth IRA? Well, how can I use that for education? That's a retirement account. Yes, but any dollar you put in, you can take out at any time income tax free. So this is a classic example of what I call off-label use. Folks, do you know what I mean when I say off-label use? For pharmacy, right? There's what the drug was designed for and used for and initially approved for. But then when the health professionals, the doctors, the nurse practitioners start using it, they find that it has other uses. For example, the diabetes medications, the GLPs, all of a sudden people lost weight. And so they start using it for that. The same thing. A Roth IRA can be an off-label use for education because you can put, let's just use a round number, $5,000 in for 18 years, right? You put $5,000 in for 18 years, $90,000 went in that account. Account grew to $150,000. My son goes to school. I can back out the $90,000. No questions asked, no taxes, and then keep moving. The next one is a new one, Trump accounts. We're going to have more information on the Trump accounts in another video. For sure, it's new on the scene. There's still some details that we don't know, but it appears that could also, it's going to be able to be used for college. Again, we got permanent cash value life insurance, and always there's going to be more work. So what you see in this column right here for education, it's an intermediate term goal. And we have definitely have some plunger accounts. We have some plunger accounts. The Section 529 plan is the big plunger there. But there's also a lot of multi-purpose accounts that can be used for other goals, which we get to our next goal, which our next goal is going to be the retirement. Of course, it's a previous goal, but we'll do it as a next goal because I skipped over it. Here, we have some plungers. What's a plunger? A traditional IRA is a plunger. Pre-tax employer plans are plungers. That's exactly what they're designed to do, and they do that job well. A Roth IRA was probably designed to be a plunger, but because it's so flexible, we turned it into a multi-purpose tool. Roth employer plans, more of plungers because you have less access to them because they're employer plans. You could do after-tax investment accounts. Again, permanent cash value life insurance can work very well. Got to be careful. It's got to be done right. But if you do it right, it can work very well. You got investment real estate. Just talking to somebody about that. It's going to be very good if you know what you're doing. Non-qualified annuities. They're the original retirement plans. And even, folks, here's one, a health savings account. Now, I'm going to pause here for a minute. Health savings account. If you saw another video I did, I said health savings accounts are only for health care. How could I have it as retirement? Well, two reasons, my friends. First, you're going to have health care expenses in retirement. And if you make it to retirement, you're able to pay Medicare premiums from your health savings account. You say, Mike, I pay those from my Social Security. I'm like, what do you mean? Well, sure, they take it out of your Social Security, but you could reimburse yourself from your health savings account. Second, at retirement age, there's no longer a penalty on the withdrawals, but the gains would be taxed, so that's not great. But the third way to do it is your whole life, when you have your health savings account, you don't take money out of it, but you keep the bills. You keep the medical bills you pay. For example, I had foot surgery last year. I know I'm getting old. I'm telling on myself. It cost me $3,000. I paid it with the credit card, but I put the receipt in a file with all my other medical receipts. So pretty soon I might want to buy a boat, and I might take $15,000 out of my health savings account to buy a boat. Why? Because the expense doesn't have to be in the same year that you take the distribution from. Folks, we don't give tax advice, and that's not the point of this video. But so you want to check all this stuff independently with your tax professional, but when you check with she or he, they're going to tell you, yes, you can do it. And if not, you can also go on our website. We got an article on it called Tax Me 3 Times. Tax Me Never. Yeah, baby. All right, we're going to keep it moving here. You kind of get the point of what we do. With income protection, now we're talking about protecting your income. You got 10, 20, 30-year term life, right? Got a lot of array of options. You got universal fixed life. You got whole life. You got variable universal life. That's just protecting income if you're dead. What's the best? I don't know. I don't know what the best tool is, right? Some of them are plungers. 10, 15, 20, 30-year term. It's got one job, and it does that job well at a low out-of-pocket cost. If you die, it provides a lot of tax-free money. Some other accounts, the whole life perhaps, definitely for me, the variable universal life, which is only by prospectus, it's a security, right? And not everybody's licensed for it. That's definitely a flexible tool. Little story. I was purchasing a house, I think it was 2013, and I needed to show money for down payment. And the woman, the mortgage, I qualified, but the woman from the mortgage said, well, you don't have enough money in the bank. You do not have enough money in the bank for the down payment. And what I asked her was, who keeps money in the bank? That money in the bank, a checking account, that's to pay the bills, right? My down payment is in a variable universal life policy, and it's earning 4% income tax free. Show her the statement. That's where my down payment's coming from. That's where my down payment's coming from. So if you know how to use the off-label uses and you use it right, you can see how you can really do some good stuff here. Okay, so disability, short-term disability, long-term disability to protect your income, a cash reserve. If you have enough cash, well, maybe you don't need any of the insurances. Retirement accounts, you buy term, you invest a difference, now your retirement account is doing it. And of course, after-tax investments too. So it doesn't just, income protection just doesn't need to be insurance, but usually when we're working with the young people initially, it pretty much does. Now, the favorite one, or one favorite topic that we want to look at here is going to be tax abatement, right? How do we pick the right tax account? Remember, it's not what you earn, it's what you keep. It's not what you have in an account, it's what that account is worth when you want to spend it. So we're always going to need some income, and the tax code is highly progressive. We've done other videos on that. So we always want to have some taxable income, to use a standard deduction, to use a 10% tax bracket, and likely to use a 12% tax bracket. So we want pre-tax retirement plans, again, plungers. Roth accounts, Roth accounts are designed for future tax abatement. That's plungers. After-tax investment accounts, well, that doesn't seem good. It's tax 3 times, as I've shown in another video. If you're in the 12% tax bracket or under, your tax rate on after-tax investments, dividend and capital gains, is 0. They effectively become Roth IRAs. So they can be very useful. As I just told the story, permanent cash value life insurance, if used properly, can be an incredible tax tool for people in higher income tax brackets. Real estate, of course, and health savings accounts. So how do we allocate across those? And then finally, the last one we're going to move to is not my favorite because it involves death, and that's kind of wrapping it up. We got wills, we got trusts, we got beneficiary forms, durables. These are all basically documents so they don't go across, but I wanted to include them. If we're being more sophisticated, we'd put legacy assets in there. So there'd be life insurance in there, Roth accounts, after-tax accounts, and then, of course, IRAs, believe it or not, retirement plans, and then health savings accounts in that order. That's what you want to pass on, right, in that order. Okay, so what you can see here, and why I'm looking at this, I wanted to show you that it's not as simple as you think. And there is not just one solution. The easy and the obvious is oftentimes not the best. And there's a lot of accounts like Ross that will go through a lot of these different ones. Cash value life insurance, off-label use, goes through a lot of the different ones. So with that, folks, I'm doing these videos to give you a peek behind the scenes at how we work with our people and the kind of things that we think about. Look, information is good. You can always do it on your own, but if you want help, if you want to sit down and look at your resources, your cash flow, your accumulated assets, the tax code, and look at all the tools that are available to you, not just the easy and the obvious, but all the tools, my team's here. We'll help you focus on your finances so you can focus on your life.